the presentation.
Thank you, Richard. And I'm thankful to be with you today and with the audience, and hoping and believing this will be useful for the folks that are tuned in and those that need some credit. We've got some great relationships, partners that I know will be dialed in today and listening. I'm happy to share a little bit about my background. First, our company, we're a private real estate investment fund manager. We've got 4 funds under management, about $1.5 billion of gross assets under management, and the lion's share of that is held in one fund that's been around since inception of this firm, and it's an income-oriented private real estate fund. And so I look forward to talking about this topic today, and I'm excited to share about my background. I spent about 16 years at the beginning of my career in the endowment foundation world, and so as we launch into the slides, I'll share those stories about how the industry was changing right as I entered 24 years ago, and I'm excited to share that perspective, and how today that is translated to opportunities to partner with wealth advisors and their clients. And so Humphreys Capital is honored to be a part of this conversation. And like I said, real estate investment fund manager. We focus on high growth markets all around the country, have investments in 15 states, and have investors from all over the country, several more states than that. And so excited to have the conversation. Hope it's helpful, Richard.
And one thing that I'll add as well is I've been speaking with you guys for a number of years and working with you for a while as well. And one thing that always grabbed me is this is, I don't know if you'd call it a quasi-family office, but it's not far off that. This is the Humphreys family, who have been real estate investors for decades and have got a proven track record in that. And it's almost like the family office model, where that is now open to outside capital to follow the guys who know what they're doing and live and breathe that. Is quasi-family office a step too far, or is that pretty close?
I would say that was our heritage, and we're an investment management firm today. And the very short story, thanks for pointing that out. The Humphreys family, a multi-gen family, has been investing in real estate for 50 years, and they had done so in dozens of limited partnerships that had 1 or 2 properties at a time. And then about 12 years ago, they began the conversation of consolidating all those efforts into an investment strategy that could become perpetual, and that is that original fund that I mentioned a few moments ago. And that began to attract other investors, families like themselves, foundations, and wealth advisors. And so I'm very thankful to have been part for almost 9 years now. I came out of that endowment foundation world and was the second hire here to help create an investment management firm. And today we're a team of 29 people and serving hundreds of investors of all types. And so, but it started with that entrepreneurial multi-gen family approach of investing in real estate, which of course is a tax efficient, long-term investment opportunity for families like this.
Great. And that's how I see the industry going, is even as recently as 5 years ago, the only alternative investment offerings that people could get was an advisor logging on to Fidelity and picking up a poor fund of funds kind of approach. And nowadays, investors are investing exactly alongside family money, family offices, the owners, the GP equivalent. Right. It's just the way the industry has moved, and one of the reasons we've seen the explosion in this space, because quality opportunities to invest alongside the big boys and the professionals have opened up. So I love the way that is moving as far as the industry is concerned. So let's just talk a little bit about what we're going to go through today. I've already alluded to it, but alternatives on the rise, and a bit about alternative strategies and how we're seeing some of the smart money invest in that space, and then move on to why private real estate is a big part of that, cover some due diligence considerations, and then finally, what this means to you is how you can use this in your business. So let's just take a look at this here. Is all of the data at the moment shows advisors and individual clients increasing their alternatives allocation. That's non-negotiable. Is all of the data shows that. And I think that has been really pushed by, yes, we've seen a bit of a rebound, but after 10 years plus of equity markets performing very well, there's a lot more uncertainty nowadays. And guys...
Yeah, 15 since the great financial crisis. Hard to believe. It's been 15 years right now, this month that we're filming this in.
That's, yeah, it's crazy. And so a historic bull market for the equity markets, and investors and advisors who 3 years ago, when I was talking about alternatives, might have said it's really hard to pull money out of equity while it's performing so well, have been ringing me back in the last 12 or so months, because suddenly it's always the pain point that causes people to get out of their comfort zone. But so that definitely helped the situation, but everyone is allocating more to alternatives. And if we look at the endowment model, is for the last 10 years plus, endowments, the smartest guys in the room, have been investing over 50% into alternatives. That is an incredible number. So the caveat to that is always follow the smart money. But the caveat to that is the pushback I get from advisors is, yeah, but these guys have got a room of 20 MIT or Harvard graduates running models and things like that. Completely true. And I know that over 50% is unsustainable for a lot of practices. But if you're at 5% alts allocation, there's still a decent margin between 5 and 50% there to actually increase your allocation. Yeah. So with the resources that we have today, with third-party diligence firms, with custodians being a lot more alts friendly, it's a lot easier and less of a brain ache to allocate to alts, which is another reason why we've seen the capital flow into it. So just as a headline figure there is that the endowment model is over 50% into alternatives. Not advocating for that, but most people I would imagine on this call have got room to increase their exposure there. Okay, so now we look at the backup to that is the performance and it's worth just spending just a moment to say, just for anyone who isn't quite up to speed with the terminology here, is the 60-40 portfolio is the theoretical portfolio that was always used in teaching historically. 60% stocks, 40% bonds. And I personally believe that model is broken and completely outdated, but that was always the textbook portfolio. Alternatives means anything that is not stocks and bonds. It's easier to say what's not an alt rather than what is an alt. So that does cause problems, that real estate can be classified in the same way as crypto, which is criminal in my opinion, but that's the way of the world, and who am I to change it? But when we look at the 60-40 portfolio here, and then we look at some of these endowments, the performance has been significantly better over this 10-year period. And that's not just the equity market underperformance, that is the bond market underperformance, which has rallied more recently. But a couple of years ago, in the almost zero interest rate world, is cash and bonds were heinously underperforming. So that's why it's important to look for not only growth, but income from alts as well. And I know that sounds off the reservation here. Sometimes people look at me like a crazy person when I say that, but alternatives can be used to replace the 40 as well as the 60. If it is a conservative yield play, in some cases, it's a better deal than actually putting your money into bonds or treasuries.
And Richard, if I can, I want to add one thing on this slide. Of course, this is a cherry-picked group of some of the biggest and best endowments But we'll show some other slides about the progression, and really the bulk of the time today is going to be spent on why, right? Why did they pursue these strategies? Why is it worth your consideration? And so I'll talk about that. But I thought what's interesting to point out here is that you don't have to outperform the 60-40 portfolio by 500 basis points as a couple of these groups did. This is a 10-year period, by the way. This is the trailing 10 years ended fiscal year June 30th, which is the last point that endowments and foundations release good data. And you see Brown over there, 12.3 is 510 basis points per year over a 10-year stretch, better than the 60-40 portfolio. You don't have to achieve that kind of success in order to make a difference. In one of my past stops in my career at one of the foundations, we did a little study on what it means if you just add 100 basis points of return over the benchmark. And to a perpetually minded investor like an endowment, it adds up to billions over time. And so, of course, professional staffs and the investment committees that provide the great governance around those staffs, they are geared towards just surpassing that standard, because any incremental amount adds in a big way to the institution's stability in the long term. And so that applies to individuals and wealth advisors as well. They're looking to beat just the traditional 60-40 model, as you call it.
Yeah, absolutely. And again, we're looking here that at a period here over 10 years where the equity market had a stellar performance. So we're not taking a particularly bad period for equities to actually skew the results here. We just because it's the last 10 years is we've taken a period that was predominantly excellent for equities. Okay, so institutions have responded by increasing allocations to alts. This speaks for itself. We know this. We know that individual investors are also increasing their allocations. Advisors are increasing their allocations. I actually read something. It was in a report recently where a couple of the biggest names in the institutional and the hedge fund world said that they can see a day where retail investors allocate over 50% to alts. That's not mass affluent accredited. That is retail investors. That's a big statement from some big names there. So this is the trend. And Ben, I'm sure you've seen this over your career as well, this rapid growth.
Yeah, this really triggers some interesting memories. Quick note, this data is a little more broad than the data a couple of slides ago that was really focused on just endowments. This includes pensions, but also endowments and foundations. And so it's a larger data set, if you will. And I want to direct your attention to the bottom row, and then I'll call out my career a little bit here. I'm in my 25th year of a finance career, and very thankful and blessed to have had the humble start that I had, making almost no money at a nonprofit 501c3 foundation that had a little portfolio to manage, and that was very forward thinking on portfolio construction. So if you look at that first pie chart on the bottom row, that's basically where the industry of endowments and foundations was at the beginning of my career. I actually started in 1999. And that looks like it's about a 7 or 8% slice right there of the portfolios. But I would say many were still sitting at zero in the first several years of 2000. Well, in 2000, second year of my professional career, a little book came out that everybody heard about called Pioneering Portfolio Success, written by the great David Swenson from Yale. And for those of us who were in the institutional investing industry, it was the must read. It was inspirational, and it laid out some of the whys that we're going to talk about today. And so look at the change from 2000 to 2010, from roughly 8% to roughly a quarter of portfolios in quote alts. That's a huge change. And then you fast forward another decade, and it's about a third of the portfolios. 2030 is just 7 years away now. It'll be larger than 33%. But we want to talk about the whys. And I've got to tell a couple of stories that I think are interesting. way back in the early 2000s, after my boss and I read the book and really began to buy into this kind of portfolio construction with private limited partnership type investments. And again, we'll save the why for a moment. We set out on a path to begin educating our investment committee. And you said it a minute ago, Richard. I remember I have some scars from the retreats we took to try to educate some of the investment committees. We made a good faith effort and literally got sent back to the drawing board with our tail tucked between our legs, because alts was an offensive word. It literally was like, it didn't matter the reasons why. They didn't understand the why at that point. So we had to weather through another couple of years of educating ourselves on the market, the opportunities, and then come back and explain why. And it was mid 2000s before we truly put the plan together to start allocating decidedly, intentionally, to a diversified portfolio of private equity, venture capital, real estate, et cetera, oil and gas, hedge funds. And then thankfully we had done that by the time the GFC rolled around. And so we actually weathered through that time, that season, better than traditional 60-40 portfolios. And then fast forward 15 years, the 60-40 model had its most challenging year ever in the calendar year 2022. And sure enough, for the calendar year 2022, those with private exposure were shown to have steadier returns, less volatility, in a short-term period of time, of course. But I can't look at these pie graphs and the evolution without understanding what triggered it and what people that were in my shoes were trying to accomplish and what it took to accomplish that. And now that is spreading, of course, to all types of investors, and we'll talk about that more. But I thought that might be interesting for the crowd.
Yeah, absolutely. I think we've all lived it. Is this evolution in the space, and even if people had a will to invest in these type of asset classes, it was very difficult to do it from a diligence, from a understanding, from a custody, from a reporting and billing. And the world is changing, thankfully, to facilitate access in a much better way. I always say that alts used to be the Amex Centurion card, which I think it gets you into the US Open or whatever, but you need to spend 250 grand a year on the card to be eligible. Alts used to be only for family offices and the ultra high net worth. And nowadays it's more like the Amex Platinum card, which even I have that one, where it's accessible to most people. So the industry has changed and continues to move that way.
Private investments aren't alts anymore. They're mainstream. They're a part of portfolios, and you still have to be very careful to look for institutional quality type investment managers. And that gets us to our point. You want to talk about the whys now? Are we ready to go?
Yeah, absolutely. And so, the next few slides I think are all you to give an overview and then touch on some of these points. So please, over to you.
So think of this. Yeah, think of this as like a table of contents. These are, we're talking about why private investments, but we're going to do that through the lens of why private real estate, because that's our expertise at our firm. And there's really 6 topics we want to hit on. So the next 6 slides, we'll break each of these down, so we don't need to walk through them. But what's interesting about real estate and private real estate being a component in portfolios, perhaps for portfolios that haven't yet invested in private investments, is that PRE or private real estate tends to be the easiest or the first allocation that an investor is willing to make. And of course, there's easy reasons to understand that. You can see it, you can touch it. Investors, they understand a hard asset with a rental revenue stream, and they understand that land is very important and has inflation hedging components. We'll talk about that, but God's not making any more of that dirt, as they say. And so it's a hard asset that people, they understand and it has yield. And so they understand the reason for holding it. So it ends up being one of those that consultants, when they're advising endowment and foundation portfolios in their committees, and wealth advisors, when they're advising their clients, it ends up being one of the first that they can adopt. And so, like I said just a few moments ago, it used to be an offensive word real estate, alts did, real estate sort of paved the way for an introductory type investment. And there's an old saying in venture capital. I'm a big fan of venture capital, invested in a lot in my former life. But they used to say you can't eat IRR. And that's very true. Except in real estate where there's yield, you should be able to eat about half of it. And we'll talk about that in just a minute. But we'll break down each of these. Think of this as a table of contents, and I'm going to move us along, and we'll start. First of all, and you see up at the top here, stable income and appreciation. You ought to get both from a long-term real estate strategy. And you can see over 3, 5, and 10 years here, roughly half of the returns can come from yield that the investor or the advisor can then decide what to do with: reinvest somewhere else, reinvest back in real estate, spend, give, whatever it may be. But that yield component is very important. And then the lighter blue is the appreciation component that you can get by owning a hard asset over the long term. And this is not our data. This is publicly available information. And so this is not from a manager that's striving to add alpha or value, but this is sort of run-of-the-mill private real estate, what you ought to expect out of both the income component and the appreciation. So that's very attractive for advisors and their clients to get cash flow, which enables the investor to see results and stay in the game, and eliminates some of the behavioral tendencies. We're going to talk about those here in the next slide. This, Richard's one of my favorites. Private real estate markets have avoided public volatility. Doesn't mean they've avoided all volatility. You see the navy blue line still moves, but you shave the edges off. If the light gray line is spiky, a heart monitor that would make any doctor nervous, the navy line is a little more smooth. And let's just be clear. Every investor has a behavioral tendency to react and respond and have knee-jerk reactions to fear. And so fear can induce those behavioral tendencies that a wise, savvy investor knows they should not react to. And that happens at all levels. One more story here from the endowment foundation world. I remember a particular time we were going to convert from traditional 60-40 into an endowment model with a significant exposure of alternatives and private investments. That would take some time, but right at the moment of beginning to refine and restate the investment policy and the direction, we encountered 08. And in the fall of 08, I'll never forget sitting in an investment committee meeting, and it was actually a long extended one with a retreat wrapped around it. And so we'd have breaks, and in the meeting, I mean, we had people literally, and these are savvy, conservative, very successful people that I have incredible admiration and respect for. But many of them were watching what was happening in the equity markets and like pounding the table and saying, "Sell, let's go to cash." I kind of describe it like Mel Gibson in Braveheart, where he's standing there holding, he's like, hold. That's what we're trying to do in the hallways in between the meetings. We're trying to say, no, we're a long-term investor. We got to stay in the game. If we get out, when would we get back in? I guarantee you it wouldn't have been by March the 9th when the market bottomed and turned back around in 2009. And so private real estate, and here's just a little example of how you can kind of take the fear off the table, because it smooths it out a little bit for the experience of it doesn't mean that the valuations are not going up and down. It just means it's smoothed out. And the structure is such that you can't call the broker and say, go to cash. And that's the kind of thing that helps investors and their advisors be successful over the ultra long term.
Yeah.
Any comments on that, Richard, before I move on?
Yeah, I mean, on the last two slides is number one, I wholeheartedly agree on the last slide that having come from the private equity world myself, and I liked that phraseology you used, is if you're sitting on a 3x paper gain after 3 years, that looks great, but you can't do anything with it. And if that paper gain turns to zero a year later, you can't do anything with it. So that's one of the things about real estate opportunities is that it does provide income as well as the potential for
Cash flow.
appreciation, which
Right.
if you're a very savvy investor who only likes the 3, 4, 5x kind of things, that's fine. But for most investors, a paper gain after 3 years, which then the public markets, the IPO market's not looking great,
Right.
it gets pushed to 2 years, it could be 10x on paper. Investors are still not going to be particularly happy with that. And then in terms of the volatility side of things, is one of the reasons I like private assets and private real estate is the valuations are not based on sentiment or the sheep mentality of public markets.
Right.
Is you see a company in one sector on the public market miss their earnings marginally and they get slammed, and the 3 or 4 companies that are similar in the same space also get slammed for no reason. And that's just the way public markets operate. Is private markets get away from the emotional investing. It's a long-term strategy. You can't one day bail, and the valuation is typically third-party valuations based on the true nature of the
and that's something that's important in your due diligence. You need to verify that that's the case, that the private manager is using a full-scale third-party independent appraisal process or valuation process. And so, like I said, people will say, well, there's still volatility inside private structures. Well, there is. It doesn't matter as much because you've invested with people that you have entrusted to manage your capital through the changing times. And so one of the benefits of private investments with locks and long-term approaches is that you can't make a mistake by selling low. You're forced, in a sense, with that portion of your, and this is why you won't see alts across the board go to 100% because people need liquidity. They need emergency. You don't go to 100% alts. The average person doesn't, for sure. But private structures keep you from sort of harming yourself or your client possibly from harming themselves at the worst possible moment.
And I wrote.
We better get moving before we run out of time.
I wrote an article which I'm happy to share called "Illiquidity is Not Your Enemy," which is basically about just
I remember that.
The illiquidity premium is long-term planning. It avoids you actually making emotional, spontaneous decisions. Happy to share that with anyone.
Yeah, I remember that paper. Let's talk inflation for a second. Again, we're talking alts, but we're talking private real estate. And if you've been paying attention, inflation has returned to the conversation. And for the last, well, really since the pandemic began, and we began to see government responses, experienced investors knew that would spell inflation. And so what you got here is a period of time from 66 to 1982 in the light blue line, put right up against a period of time from 2014 to present in the navy blue line. And there's several conclusions you can draw here yourself, but the point is inflation's returned to the conversation. What's not shown here is the period of 30 years between 1982 and 2014, where inflation was sub 2% for an incredible amount of time. So for people's entire careers, inflation wasn't a concern. Now it's a part of the conversation in a big way. And this right here tells you, if you look at the navy blue or the light blue line and how it spiked again in 78, 9, this is why the Fed is so active and why the Fed is trying to stamp out inflation, is they're trying to prevent that from occurring. And there's all kinds of proponents and opponents of what they've done and how fast they've done it and that sort of thing. But that's what they're trying to prevent. And not shown here is what the equity markets did. You might want to take a look at what the stock market did in the 75 to 79 or 80 timeframe. It was volatile and sideways. And so equity markets tend not to like higher interest rates, and higher interest rates, as we've been hearing a lot lately, higher for longer is the expectation for many people. But private real estate gives you the opportunity, not in a 1 or 2 year time frame, because spiking rates can wreak havoc in in the valuations of properties in the short term, but over the long term, private real estate gives you an opportunity to participate in inflation and through rent growth and through the appreciation of the land or the hard asset affixed to the asset. So that's another important component of private real estate.
And that graph is thoroughly terrifying at how similar, eerily similar that looks. And if that's the way we're going, it's very hard to find assets that give you not just a hedge there, but you can actually benefit from inflation. And hard assets are one of the few things that can.
Well, this is why the navy blue line, if you expect that the Fed will aggressively start cutting rates in the near term, they don't want that light blue line spike to reoccur. So I'm not confident they're going to be cutting. It's a higher for longer time, in my opinion. Let's keep moving here. One of the other components of private real estate contributions to a portfolio is the diversification that it can provide. This is a simple correlation chart. Direct your attention to the private real estate column that's shaded in blue, and what you'll see is its correlation. Again, this is no one manager. This is from an index and how it moved over a period of time. I believe it's a 15-year period of time, and what you see here is 4 asset classes: large cap stocks, corporate bonds, public real estate, and 3-month T-bills that are not correlated with private real estate. 0 is perfectly not correlated. 1 is perfectly positively correlated and moving in lockstep. And -1 is perfectly inversely correlated, moving exactly opposite of one another. So when you're assembling a portfolio, you of course want pieces of the portfolio that don't act like the other pieces. And you see anything under 40 basis points of negative or positive correlation as additive to the stability of the portfolio. Private real estate can be very helpful at providing that kind of diversification. And then if we were to stick,
just going back to that slide, that's a surprisingly low correlation with public real estate, considering it could be almost the same asset class, but just whether it's private or public. Is that all down to what we talked about, the emotional side of investing, and the sheep follow the people who slam a company for missing their earnings or whatever? Is that
I think emotion is a part of it, and I think time lag is another part of it. It's like the market is an amazing thing, and the market is made up of millions of opinions all at once. And so yes, a lot of it's emotional, but you can trust those valuations, and it takes private real estate longer, or private equity longer, to show up in the valuations. So that doesn't mean you don't see valuation downgrades in private investments. You just sometimes see them later, and that ends up creating, and if your valuation is strong, then it's accurate, and that's very important. But it zigs and zags, partly because of the lag, which contributes to the calmness or the peace of the investor weathering through times. It goes back to that volatility line. It's like if it's as a portfolio down 5 or 10%, that's way better than down 37. And that evokes fear when it's so incredibly negative at one time. So but if valuation is being done fundamentally, when interest rates go higher, then valuations are lower for that season of time until you've created the new value. I'm going to proceed here. Let's talk within diversification, or within another type of diversification in real estate. Just a little piece of explanation. If you're not a real estate specialist, you might see these terms thrown around: core, value add, and opportunistic. And opportunistic can often also be synonymous with development. Investing in real estate is very diverse. We like to say in our firm, we practice 3-way diversification by market, sector, and strategy. Market meaning geography and locations, sector meaning property types, multifamily or industrial or self-storage or whatever it might be, And then by strategy, and this slide is just showing the differences between strategies, core, value add, and opportunistic. And each of these three types of real estate perform differently in different environments. In an inflationary environment, you want shorter term leases. And so if you've got a property that you're renovating and turning the leases, then you're going to benefit. So value add can reap the rewards of an inflationary environment if you're turning leases while creating new value. And just to further explain, in the long term, core is a lower risk, lower reward type strategy. In the long term, opportunistic is a higher risk, higher reward strategy. You ought to get higher returns, but you have construction risk and execution, timing, budgets, all sorts of things that come into the picture there. But at the end of the day, you ought to make significantly more return if you perform well and have great partners, and the market rewards you for the time that you're building the product. I like to think of opportunistic or development as, using the Latin phrase ex nihilo, creating out of nothing. And so you take a piece of dirt and or a building and completely repositioning it to something else. Value add is taking an existing building and improving it and renovating it, and therefore creating a higher potential for NOI from your tenants, because it's a better building after you run your project. And core is almost like a bond in that it's an asset. You're not improving it, and it has cash flow. And so in different seasons, it can be better to buy or build, and the professional is in a diversified fund is entrusted to choose which is the appropriate in this season. And so I thought that might be helpful to just talk about some of those differences between the various strategies within private real estate. And then we just got a couple of slides left here. Richard, I think we're going to save some time at the end for Q&A. But there's two more points that we really wanted to talk about. This is the last one of the table of contents, and then we'll get into sort of the practical application, due diligence, and the practical application. But the last reason private real estate is particularly or potentially helpful for wealth advisors and their clients is its tax efficiency. There is a reason why the highest net worth investors in the world, whether they're individuals or large family offices, there's a reason why they're invested in real estate over the long term. A lot of their net worth will be invested in real estate one way or another. And one of those reasons is the tax efficiency that it provides in the short and the long term. And so what we've got here on this slide, we've got another version of this that has a few more columns, but we trimmed it down here so that you could just focus on a couple of scenarios. I think a couple of numbers will help land this point. If you had $1 million invested in a strategy that gave you a 7% cash flow, annualized cash flow, the sources of that cash flow provide a very different tax experience. And so look at scenario 2 on the right, first of all. If the strategy was generating 100% ordinary income, and in real estate, that might be core properties throwing off cash flow, that actually still wouldn't be the case because you're going to have depreciation. But if all the returns were generated from ordinary income, a 7% distribution is a tax equivalent 4.4. So it doesn't sound quite as compelling, obviously. But if you through value creation or creating capital gains, value add and opportunistic actually give you that potential. And if in a perfect world, 100% of the returns generated by the fund were capital gains, then a 7% actually becomes an 8.9% tax efficient yield. So if you put that up again today in this environment, cash is king, and we're in 2023 right here, and there's a lot of rate uncertainty. And if I've heard it once, I've heard it 1,000 times. I like my T-bills right now. They're paying almost 5% or right at 5%. Yes, that is, to a taxable investor, that is ordinary income. And so to a long-term investor in real estate, if you're getting a cash flow that comes from capital gains or in the short term from return of capital, then that cash flow is materially enhanced from a taxable perspective. And so wealth advisors and their clients really might be interested to think of real estate in their portfolio as something that can generate consistent cash flow, can provide all the other things that we've talked about in the last several slides, but also provide a tax efficient way to get a regular stream of income. And so you don't get that from other types of private investments to the same degree that you do in real estate, where you get the benefit of depreciation and amortization and capital gains and so many other things. Any questions on that, Richard, or points you want to add to it?
No, I don't. I think you covered it all.
All right. Well, let's wrap up here. I'll let you tee this up if you'd like. We've kind of finished the table of contents, if you will, and now we step in these last two slides to a couple of practical things. One on due diligence. Anything you'd like to talk about before I add a little bit of color?
Yeah, so I mean, a couple of things for the audience is, number one, we're coming to Q&A shortly. So anything that you'd been sitting on, please type it in and we'll get ready to answer those. And I was just going to say, I believe you have a DD report in case anyone here wants to get hold of that.
Sure. For wealth advisors who subscribe to Buttonwood is a service provider we've used, and I think they call it an AIM report is available. If we're talking due diligence, this list is sort of what I refer to as like the table stakes, things that ought to be evaluated and just have to be in place, or the advisor and the client need to understand before investing in an illiquid private strategy. But one thing that's left, and I'm going to talk about a couple of them, but before I do, there's one thing that's not on that list, and that is people. I heard somebody at a conference say that last week, so I'm going to steal it. In real estate, everybody talks about location. That's been a phrase been around forever, and it's very true. In our vernacular in real estate, we talk about markets and then submarkets. One quadrant of the city or pocket of a city can behave completely differently from another, and so the location is incredibly important. But in fund management, particularly private fund management, where you're locked up for a longer period of time, you're partners, and so first and foremost, you need to know the people you're investing with. When I was in the endowment foundation world, what I did was jumped on a plane and went and saw every private investment manager that we contemplated hiring. If they were a finalist in a search for us, I did the kick the tires, go meet them, shake their hand, look them in the eyes, sit across from, break bread. And we believe that is a fundamental part of the recipe of successful long-term investing is investing with good people. But then when you're doing your due diligence, you need to understand the strategy. Does it fit in the portfolio in this environment? Does it make sense in this environment? Do they have a track record? You can often see pop and flash and excitement that someone promises in a local real estate deal. The question is, do they have what it takes to weather through the challenges that will inevitably come? And can they repeat it the next time? So track record helps you understand how a firm has weathered through various seasons and what their batting average is, if you will. And the one I want to talk quite a bit, or not too much time, but that is very important, fees and compensation structure. I'd say it differently, and that's alignment. At the end of the day, investors and investment managers have to be aligned. If they're not, the manager is incentivized to do something for their own good instead of the investors. And so fee structures in a maturing private investment industry, this is something I'm very proud of in the industry. When alts first became a thing 15, 20, 25 years ago, before they were mainstream, people with a great reputation and who were eloquent and attractive presentations on stage, they could win allocations with very misaligned terms. And that's changing. Nowadays, in a maturing private investment industry, you can look and find investment managers that have very aligned terms where they only win if you win. That's what you need to be looking for in the fees and the carries and the embedded incentives. What is that manager incentivized to do? Are they incentivized to grow their balance sheet? Or are they incentivized to make returns for you on paper? Or are they incentivized to give you cash? And so that's a very important one that really wealth advisors, certified CFPs, others really need to understand, like what's at the heart of a private investment that I'm considering for my clients. And then I think that kind of takes us to the end, Richard. And so I don't know if there's going to be questions. There's one final slide here, and this is the practical. Anything you'd like to add here before I share?
Yeah, sure. So, I mean, just on what you were just saying is, we said at the beginning, the fact that this is a quasi-family office is it's allowing normal investors to come alongside generational family office type opportunities. So it is, that's very much about the people is. So yeah, just to reinforce that, I think that's something that applies significantly to you guys. And then in terms of, I always say on this slide is, this is not a university business school lecture. Hopefully you've learned some things along the way, but what does all of this actually mean to you? Is how does this impact you? And private real estate, but let's talk generically here about alternative investments and chances to invest alongside family office money if you don't have them, it's a competitive disadvantage. Your competitors will. If you have them, you have a better chance at bringing in sophisticated, high net worth money. I don't know any sophisticated investors who are going to 60-40 model shops nowadays. Diversification, we've banged that over the head as much as I think we need to. There is how that fits into a diversified profile in terms of return profiles. Longer term planning, we've talked about the illiquidity premium, staying away from everything doesn't need to be liquid. Is longer term planning means if you are 100% liquid, you're giving up percentage points on the illiquidity premium, and dare I say, you're not providing the best service for your client. If you've planned this out well enough with your client, you should be able to lock some percentage up into a liquid investment. Client demand, we live in a world of perfect information. Some of the information is actually pretty imperfect, but clients know about a lot more stuff than back in the day, and will have heard about things that a few years ago, would a client have come and asked about DSTs, OZs, or whatever to their advisor? And so clients know about this stuff, and they're not going to be happy with the old school portfolios. I wrote a paper a few years ago now called "In a World of Fee Compression, Avoid the Race to the Bottom." Is don't compete with betterment at 15 bips. Keep your fee at 1%, but provide a better service. And it's quality institutional products like this private real estate that we're talking about that set you apart and enable you to maintain your fee. Yield, it's not just about the total return, the IRR, is yield options in your portfolio. Bonds can be replaced with yield generating alts. Alts don't have to always come from the risk capital. And asset backed is in this world with inflation, and also as part of the longer term planning, illiquid asset backed investment strategies are not going to be tossed on the waves of the public market.
And I'd add just 2 or 3 quick comments, and then let's take any questions that you've collected. On client demand, endowments and foundations, think about those boardrooms where we were educating ourselves and educating the investment committees 20 years ago. I have people that the kings of our state, the kings and queens of our state, they had created amazing businesses, and so technically their wealth was generated in the private markets, if you will, but their portfolio was all public. And what happened after our educational process and after our advent of alts in our portfolios, they started doing it as well. They started hiring the same consultants and some of the same managers, and that trickle down effect has happened. And so now every millionaire next door is asking their wealth advisor, hey, where's my private equity or my private real estate? And so I think there's going to be a continued demand, and I believe practices that are forward thinking are looking for the best ways to deploy capital with good people and competitive advantage. You have a competitive advantage if you can say to the client, no, I've met these people. I've been to their office. I've had lunch or coffee with them. I know what kind of car they drive. You know, that kind of that gives you a competitive advantage instead of just a giant product from Wall Street that is you know, might as well be a million miles away in terms of direct relationship and advantage and access. And long-term planning, I think this session gives continuing education for CFPs. People with the CFP certification are trying to look at the whole picture and help plan for the long term. So you can look for private investments that fit in IRAs and that meet a certain need for your client in 5 or 10 years. You can use private strategies to help complete the whole picture. And there's other things I could say, but I'll stop there and we'll begin to wind down.
Sure. So let's just give the details here is that I believe there's a fact sheet on the handouts that anyone who wants to can download on your portal here if you want to do that. And if you want to learn more about what we've spoken about today, here's some details to get in touch with Humphreys Capital. And if anyone wants to talk more high level on the alt space, then please get in touch with me. My details aren't there, but it's Richard Hillson, Hillson. Find me on LinkedIn or whatever, and happy to talk about that. I think the only thing I was going to say, Ben, is in fact, do we have something on the chat there?
And while you're pulling that up, like, I'll just say this about the team. I'm so thankful for this team, professionals, and very likable people that if anyone would like to, you know, discuss our experience and our perspective on the market, any of us would be glad. And of course, we've got more that are not pictured here that basically make all this happen every time we have an opportunity to connect with people. So thankful for this team and all of their great work and to work alongside them.
Absolutely. There was another question that just came in, but I think we've got about 1 minute left, so I won't make you rush through that, Ben. But just to, as a last 30 seconds for you, Ben, anything you want to say in summation?
No, I hope this has been helpful. I've enjoyed talking about it with you. Obviously, it triggers some memories from my career that I'm very thankful to have experienced, proud of what we accomplished, and humbled at the same time. And so I hope this has been helpful for the audience. There were a couple questions that we'll respond to directly, and we're here if any of you would like to reach out and talk further just about the topic at hand.
Excellent. Well, thanks everyone for joining. Remember, get in touch with whomever invited you as far as CE credits are concerned. Ben, always a pleasure, and I hope this has been useful for everyone who attended. So thank you, everyone. Thank you, Ben, and have a great rest of your day.
Thank you, Richard. Enjoyed it. Always good to work with you. Appreciate the time together today.
Thank you.
Bye.